Hello and welcome. I'm Andrew Sachs-McLeod, Chief Executive Officer of FinanceFeeds. And here today in Limassol, Cyprus, I'm joined by Paul Orford.
Hi, Andrew.
Hi, Paul. Nice to see you.
Great to see you again.
And Paul is VP of Business Development at TopFX, which is a prime brokerage and liquidity provider based here in Cyprus.
That's correct.
And today we're going to have a bit of a chat about what companies and individuals and the whole industry is focusing on, and in fact not focusing on.
Yes.
Which is really interesting. Oil.
Yeah.
We don't really talk about market-related matters that often, but oil has collapsed in price.
Completely
collapsed. And that is what is worrying everybody about the commodities market. And we've talked before about the fact that oil is different to other commodities like raw materials or precious metals, in that it isn't an actual read across from a currency, it's a fuel.
Yeah, that's it.
So it's different, and other factors are affecting it, such as electric cars, solar panels.
Correct.
The fact that more machinery is more efficient nowadays, so the demand is less. These are factors that don't affect things like gold. But what's being missed here is that whilst multi-asset commodities is a big deal these days, FX, particularly interbank FX, is being ignored when you bear in mind that companies like Deutsche Bank and Credit Suisse, their stock and their corporate performance is falling at a much higher rate than oil.
Well, it's a very interesting point that you raise, because we've talked about it personally with regards to Deutsche Bank. But outside of our conversations, have you seen anything reported really about Deutsche Bank?
No. Yesterday, we talked about it yesterday. We published yesterday on FinanceFeeds about this. But it hasn't been something that's the focus of the whole industry.
I hate the cliche, but it is the elephant in the room.
It is an elephant.
You know, where people are just not talking. It's a huge, huge story. We first spoke about it, I think it was last September, where we discussed there was a filing or something like that where they had a loss of 4.4 billion euros.
They predicted a loss of 4.4
And even
billion
then, it was kind of swept under the carpet. Everything's all right, no need to worry. Right. However, yesterday when the CEO came out and said, calm, we're okay, we're rock solid, isn't that kind of, in football parlance, the vote of confidence? You know, from the CEO, from the chairman, you know?
We saw Joshua Raymond, who's now marketing director of XTB. He used to be at City Index for many years. He actually was tweeting yesterday, this is the very uncomfortable vote of confidence. Because the CEO and the
Schwabel, the German finance
minister, he came out and actually said, "Oh, nothing to worry about. Everything's okay." That reminds me of a year ago when the Swiss National Bank removed the peg on the 1.2 peg on the euro-dollar. And then the next morning, all of the retail companies which were running an A-book system, some of the smaller ones, which now don't exist anymore, had come out with press releases, we're okay, we're well, very much the same parlance. Very much the same parlance.
I mean, I'm sure the captain of the Titanic said the same thing when he was rearranging the chairs.
That's right.
But
rather than where's all that oil coming from, or where's all that water coming from.
That's it. But who knows? I mean, it's a very interesting story, but it's going to have a huge impact. It's having a huge impact now because of uncertainty.
Right.
And uncertainty brings the volatility.
It does. I think it paves a good path for the retail and the non-bank institutional forex companies. Companies like FXCM, like Saxo Bank, like TopFX, like Advanced Markets in America. Companies like that are non-bank liquidity providers that are now forging multi-asset partnerships, because Deutsche Bank is particularly having these difficulties. It's the second largest interbank forex dealer in the world, 14.5% of global market share. And it's in the dire straits. So now you have a path being paved forward away from the interbank sector and into the institutional non-bank sector.
That's it. It's going to be a story. It's going to run and run. Even you've got to have sympathy for them. But even when they try and put water on the fire, you know, people say, "Oh, there must be something behind this." You know, the guy could be completely legitimate and saying, "Look, everything's okay." But we're naturally pessimists, I guess, when it comes to things like this.
We are indeed. I think the fact that it's okay, they do most of their forex business in two places. The majority of their order flow is London and in the Far East. Now, the London banks, such as Deutsche Bank, HSBC, which is a Chinese bank by origin, which has a license to actually print dollar bills in Hong Kong. So it prints sovereign currency. They're all looking and RBS and Standard Chartered, they're all looking towards going to the Far East. So they might move out. So if they do, I understand why. It's a young, urbane, sophisticated population, there's much more people. Most of the massive order flow is coming from those regions anyway. However, you've got London and the Far East as far as Deutsche Bank's distribution is concerned. It's the second in the world. but you've also got big competition there now from the OTC companies.
Yeah.
And they're getting, now you have in Shanghai, there's a trade zone there.
Yeah.
Many companies from the West are moving in. So it may be that the trading desks of these big banks won't be able to turn their fortunes around short term.
Yeah, it's going to be very, very hard. I mean, would it also be contagious for other banks of a similar ilk? You know,
Yes.
would they start looking at them more seriously? You know, it's. I
believe it would. Yes, I think, for example, you know, you have Credit Suisse, which last week produced their lot. They had the first loss, first annual loss. In 2015, the first annual loss since 2008, which was pre-financial crisis.
Yeah. Well, I read that informative piece on your website the other day with regards to that, about the bonuses as well.
Right.
Exactly. You know, they're still paying, like, you know, for losses, you know, paying bonuses.
They are.
This is crazy.
The only thing that's different is that the CEO is taking... This is interesting. The CEO took a hit with his bonus. He doesn't declare what it is, but he's still going to get a bonus. Even though the company is and Credit Suisse is also a very large FX dealer, interbank FX dealer. Yeah. So I think this is a problem. Now, Germany has a difficult economic situation as well at the moment. So not only this is why the finance minister is probably concerned about it, because that is a big forex dealer. It's not got all of its eggs in one basket. It's Britain, which is a massive banking sector, and it's the Far East. But it's a German company. It's listed on the Frankfurt Stock Exchange. So the problem is he's concerned about that, because that is one of the biggest economic financial powerhouses in Germany.
Yeah, that's it.
Germany's economy is in a bad state.
Yeah, well, when you think Germany, you think BMW, Porsche, Deutsche Bank, these kind of blue chip
legacy
flag
companies.
Yes. And if one of these pillars of the German economy was to go down or face problems, then again it gets contagious.
It does.
People do think, instead of going, oh, it's German, it's solid, it's strong, you know, nothing exciting is going to happen, but it's never going to collapse. You know, it's going to be strange times.
And it's actually a time where they are, that particular bank is one which has got an electronic trading sector which is big, compared to the rest of Germany, which doesn't. Most of London is reliant on the electronic and fintech and the financial sector, and the very modern version of that. Yeah. Germany as a whole country has a legacy manufacturing. It's car manufacturing, it's old-fashioned engineering of raw materials and things like that, which are not sustainable in the long term. But Deutsche Bank is its crown in terms of financial system.
The future sort of thing, isn't it? Yeah.
But now it's problematic for them.
Well, time will tell, as they say. You know, I mean, it's I do feel for like I say, the CEO, because he can't do right for doing wrong. No, you know, if he comes out and says nothing, then he's done for. If he comes out and says, everybody don't worry, it's all great,
that's
he's done for as well. You know,
and I think that this is another thing that's interesting. What about companies that take liquidity aggregation, prime brokerages and liquidity providers that take liquidity aggregation from Deutsche Bank, when there are concerns over capital adequacy? And not just adequacy, but the way the funding of the company is now in difficult position. You saw part of the reason why the government got involved in it, and their finance ministers actually went out and spoke out, is because of investor concerns about the capital position of the company. So if you're taking liquidity from them as a liquidity provider, do you think that's something that would put off liquidity providers from using them?
I guess because it's no different than when the smaller client comes to a prime of prime and they want to know about your capital, you know, what you have, how, you know, how good you are as a brokerage and liquidity provider. It'd be the same as me going to a prime brokerage and wanting to know that, is my money safe, essentially? Am I going to go out of business if you collect, you know, what are the fire guards and the checks that we've got there to make sure everything's okay? You know, and the trickle-down effect, if it does go wrong for them, could be staggering, really staggering. I agree. I mean, it will go to then the prime brokerage, the prime of prime brokerages, to the retail brokerage, we'll call it, and then to the end user, and it would radically change FX as we know it.
Yes, it would.
I mean, it would be the nuclear option, I think, that day, wouldn't it?
It
would be a huge hit to the industry.
Right. I think also they didn't consider, you know, if you have a capital position like that, then this is allowed to carry on. You know, if you look at the time going back a year or so, a non-bank brokerage or prime brokerage or liquidity provider would have been stopped. They would have been closed out. Whereas these companies are allowed to carry on doing so, even if the capital position is no good. So it's almost like sleepwalking into a dangerous situation.
I mean, let's just say the worst case scenario. Let's say it does capitulate. Who is the backstop for that?
That's the thing, isn't it?
I mean, who pays it? I mean, They must have a staggering amount of money.
They have.
You know, I mean, like, would it be more than Greece? Like,
yes,
so
sure.
it would be a matter for the ECB to come in and write a check.
They would do
you
that.
know, it would. Right. It would. Otherwise, it would be huge.
But then what that does is transfer this problem to the economy.
Yeah.
So then you have, you know, you want to talk about where is the B book here? If you're if you are an A book provider, yes, you're processing orders to there, to the liquidity provider. Then it goes from the liquidity provider through the aggregator to the banks. Where is the B book? If the B book is the bank, if you can call the bank the B book,
you're right, essentially,
and the B book isn't in a good position, then what? So it could be that the German government, which Germany is a socialist country, doesn't really have a very good entrepreneurial business ecosystem. It's either large corporate entities or government sector, or large corporate entities with a big shareholding held by government entity. So then the risk is it has a problem which will affect the economy. So as you say, the ECB will then write a check for it. But what that will do is destabilise the nation's economy even more than it already is.
The confidence will just go through the floor.
Yes, it will.
And what does that say for Europe as a whole after then? If it's Germany, it's actually got the problem. We will talk about Italy, Spain, you know, the southern Mediterranean countries. But if really the leader of Europe, if it gets problems,
then it's difficult.
Doesn't bear thinking about, does it? Right. I mean,
it's almost like being think of it as being like a startup, and your investor pulls out. That's what it's like. That's what it'd be like, but on a very big scale. So I think, as far as that's concerned, it still allows some of the non-bank companies, as long as they've got good aggregation system, to prosper and move more into different sectors of the institutional world.
Well, it's an interesting thing because it's very similar to the UK. Back when we had the crisis there. Now, one school of thought is you should have let the bank crash. Right. However, the fallout of that is big as well. You've got like people's savings, the whole, you know,
it would make
the whole trickle down effect. Yeah. So, what would you do if you were the government, for example? Let me put you in that position. I know it's a hard thing to say to you.
Exactly as you say. You talk about 2008, 2009. Well, the banks should be made responsible for their irresponsible lend. You see, it wasn't the back then. It was a different matter. It wasn't the FX or digital trading business. No. It was the retail. Banks found they couldn't make any money from retail banking anymore. So they started trying to invent the rules as lending money to people who self-certificated their mortgage, 110%. So what you had was somebody who doesn't really earn any money, living in a house that they thought was theirs, driving a new car which has been funded by the bank that bought the house for them, and then there's nothing left. In the end, someone has to pay this.
There's always a pay.
Someone has to pay it back. There's a capital that's not being paid, interest only. Someone has to pay it back. So it was a different circumstance. But I think the best thing to do, in my opinion, would be what would have happened in the US? Chapter 11 bankruptcy, start again. It's the only way to solve the problem. But because it's a different system, the European system is concerned about social stability of businesses and of those affected, so they will bolster it with the taxpayer. But the problem was that most of the lion's share of that was used to sponsor the remuneration packages of those being made a scapegoat for the problem in the first place. People like Fred Goodwin, who took away.
Fred the Shred, isn't it?
So this is the problem when when it looks like it's a bottomless pit and there's no accountability. It's a problem. If there was accountability, and it could be that the margin, you get the margin call, and then they say, right, that's it now. Then they won't do it because they could be held liable. In the US, if you did that in the US as an entity, for example, that offers a book system, you don't do risk management systems properly. The CFTC will publish on their website the lawsuit they're about to do you for. And you'll just be everything will be restituted, the clients will get the money back, they'll come and take your house, things like that. It's a different system. My opinion is they should have probably let them go down, actually.
No, well, it's the impossible question, isn't it? Even with hindsight, it's hard to say X, Y, or Z, you know, because if you live in a capitalist system, you should let the silent hand of the market do what it does best.
There should be responsibility. You know, if you're in charge of this, there should be responsibility in terms of risk management.
And where was the responsibility?
Well, that's the thing, because there was no responsibility, because they knew there would be an IMF bailout and a public shareholding. There wasn't any. So
you're a man who goes to London a lot. Do you think a lot of things have changed?
No, not really.
No.
In some respects, yes. It depends who they are. You cannot, for example, In the institutional trading sector, that's still as strong as ever.
Yeah.
You have a very big institutional sector there. You can get liquidity from most of the companies. They're very strong, most of them. You have companies like LMAX, which is a very high-tech company, financial, very strong. Those sorts of companies will never have problems. But the banking sector is in big trouble now and hasn't really improved its balance sheet since 2008. They've had some reforms, but they can't. Barclays last year, 2 years ago, was looking at laying off 19,000 people. They had terrible corporate reforms. Barclays is a massive interbank forex dealer. So they just don't seem to be able to. Now they're looking at moving their operations to the Far East because of the ease of doing more business there. But I don't think that's really the solution in the end. The real solution is better risk management.
Yeah, definitely. But is it too late?
Yes, I think it is.
Yeah, I think you are right.
I think it is. In the US, no, because you have it's different.
There's a flexible system,
very
though, isn't
flexible system. You have the prop shops of Chicago. You have all these proprietary trading desks. Most of them are tied in with specialist liquidity providers that are directly in the market, and they are responsible for their actions under the NFA and CFTC.
Yeah.
So it's different. But I think, yes, I think it's now a tipping point where we're going to probably see the IMF and the taxpayer saying that's the last time we're doing anything.
It's true that. I mean, remember the people have to get elected as well.
Yes.
Because it doesn't matter if it's the president or the prime minister actually signing a check. It is reflected on them.
It is.
And they've got an electorate to answer to.
Yes, they have.
And they're constantly on the electoral trail. So if they're seen as being, we'll call it in the pocket of the banks, which is debatable if that's true or not, I don't know, but if they start writing these checks for failed banks again and institutions,
then it's a waste of money. Because the thing is that you could have justified, probably back at the time of the financial crisis, you could have justified it because they could say, one of the government accountants could come and say, look, it's going to cost us 75 million to buy a public share in Lloyd's Bank or something. But the banking business and certain sectors of the banking business doing well. The electronic trading business back then was booming. So the taxes paid from that will actually benefit the country. But now they're making losses. There's no tax if you make a loss. So it's government funds, it is investors' shareholdings, it is large conglomerates that have major shares in the companies, no dividends or reduced dividends, and a loss, which means no tax. So they will just stop doing it in the end. That's the thing.
Yeah, it's an interesting point, but you're right that the second crash, which may or may not come in the near future, the signs that we can see, there is a slowdown coming.
Yes.
With like oil, China, the banking stock, what we just talked about, it's going to act as a catalyst to slow things down a hell of a lot.
Most certainly. I think China is smart because China is different. It's not a free market economy. They own the Shanghai Stock Exchange, and all the major venues are owned by the government. All of the companies listed on them have a minimum 50% share owned by the government. So therefore, the Chinese government can completely control the market and the prices, which is why a lot of Chinese investors do not invest in Chinese stocks. They will go to a big IB or portfolio manager in China in one of the tier 2 development towns, take their property, take the money they've invested in property, the profits from that, retain their property as assets, and trade FX on a big scale. The reason they don't want to do the Chinese stocks is because the government influences it. Now, the government will crash the Chinese stock exchanges to some extent because they will do it on venues where Chinese companies that have partnerships with British or Western companies will list so they can influence them and then buy them for cheap.
Makes sense. Now, I also read about the shadow banking with regards to like a large company. I'm not sure, like Baidu, for example, just take that as an example. They would lend money to a smaller company to start up, and they would then, if they default, but these companies have lent billions.
Yes, they have. Alibaba and Baidu and companies.
So if the smaller companies that they lend to default, what happens then? I mean,
that's the thing.
That's another strain upon the economy, isn't it?
But it's a different strain because in China the companies are cash rich because they can't, but they don't have any credit lines. You have to come with the cash, and if you have some of the cash, then you need to have a 50% investment from the government. Government buys half your company, sends all the management consultants in for free, so it drives your company forward. So there's no debt. If the company that they sponsored goes down, it just means they lost $100,000 or something. It doesn't mean they didn't hedge it against something, so it won't affect their business that much. So it's different. If the banks and the sponsors of these companies in London, if they have a negative balance sheet, and the fintech company or whoever they lent the money to has a negative balance sheet, then the creditors will come in. So it's different.
So with regards to oil, which has been a very interesting story the past year or so, What are your thoughts on that? Where do you think it's kind of going to go?
I have two opinions. One is a very kind of retail-orientated opinion, which has nothing to do with our industry. But it's purely, it is relevant still because it's the end user. The user of oil is people who use fuel for their house. Nowadays, I don't know anywhere which uses oil really for fueling domestic houses, electricity nowadays. Usually fueled by nuclear power stations. So that immediately means there's less demand. But for example, my car is 15 years old. It's not got the latest technology in terms of engineering and so forth. I've used 2 years ago, fill it up. It cost me $60 to fill the tank. Now it's $35.
Which you've got more money to put into the economy as well, haven't you? Yes, so it should act as a stimulus.
It should act as a stimulus. It will encourage people to go to more places. It's great. However, it will also stop you buying a new car. What's the reasons for buying a new car? You think, oh look, Tesla have got electric cars now. The price of gasoline is so high, then I might as well pay $60,000 once. Buy the electric car and have no more running costs for years.
Well, it's true when it's at $120 a barrel. It was a fantastic idea, then, wasn't it?
Cheap. So the problem with that is that the end user benefits, but the legacy companies like BP. Did you see BP's results? Not good at all.
That's it. Well, the fundamentals
and they don't have a backup because their legacy. This is a refining. Most of they're going to lose 4,000 people this year. Most of them are from the downstream business, refining the old-fashioned, what you could call perhaps manual tasks that need to be carried out to provide this resource. They'll lose those people because the company is not sustainable in its existing form. These old, it goes on the same thing. It's a commodity, but it's a legacy commodity. And the old-fashioned way is now a thing of the past.
Well, look, the fundamentals have changed now because, like we discussed before, you have new innovations in transport. The Middle East, the inflamed situation with ISIS, normally would have sent oil through the roof.
Yes, it would.
But nothing. It's tanked, you know. Shale, I mean, okay, although a lot of the companies are going out of business, it's not like they're going to uninvent shale. You know, this genie isn't going back in the bottle.
No, it's not.
I've read as well that although you've got a lot of companies going out of business because they were leveraged far, far too highly and they're priced at about $120 a barrel. But you're getting the larger companies take over the small shale businesses and you will see America become independent.
Yes, I think so too, which is great.
It's
a good
definitely.
thing.
Because with the Saudis, what they were they're a swing producer, they could turn a tap on and off. But people don't understand that OPEC is only 30% of the world's production. I always assumed it was 60 or 70, but when you actually read about it, they don't have a great deal of say of the whole thing. It's quite interesting.
Canada does, Russia does.
Yeah, that's it.
North Sea.
Yeah, and also if they turn the taps off, they're going to lose market share like they have before.
And there's no backup.
Well, that's it. Well, you've got an interesting dynamic in OPEC now where you have the smaller nations like Venezuela, for example, saying turn the taps off.
That's a very oil-rich country, but it's aligned with the thing is, that's also not a free market either. You can't do business with them.
So, but they need the taps turned off so they can make some more money. Otherwise, you have massive social unrest, which is probably happening already.
That's right.
And also Saudi Arabia, what's going to happen? Or the Middle Eastern region. Do you know if the price goes too low? You've got to keep it low. If it goes too low,
there's already Dubai, for example, now Dubai has financial trouble purely because it's an oil. It's an oil economy, and there's no alternative backup. The whole of Dubai built 30 years ago or something. It was built using imported foreign labour, imported foreign equipment, everything. But there was no. It's not a fintech hub. It's not a diversified economy. It's purely sponsored by oil wealth, mostly from Saudi Arabia, Kuwait, which is now struggling. So they now have financial difficulties, and there is no backup for them. So the DMCC, for example, which now you have a lot of exchanges there, are trading. DGCX, which is the Dubai Gold Commodities Exchange, is the most prominent venue in Dubai because it trades gold. And the Indian rupee contract. Futures contract.
Well, that's going to be very popular there, isn't it?
Very popular, because there's a lot of Indian expatriates there, and they're trading the INR against the dollar as a futures contract on the Dubai exchange. But oil, nowhere to be seen.
Straight. You thought the homeland of oil, we'll call it, it's not there. But they've got currency reserves of around 750 billion.
Yes, they have.
How long would that last? Really?
Not long, really.
It's not, is it?
Without
10
an
years?
without a diversified industry, 10
it's
years.
Nothing, is it?
That's right.
And then what?
Exactly. Very interesting indeed.
Start making the solar panels now, maybe.
There's plenty of sun. There's plenty of sun, that's for sure. That is a finite resource.
That's it. But we'll see what they do.
So, you know what? That's just before we close, that's interesting. Weather conditions. Do you remember, going back 20, 30 years ago, before the electronic retail trading, you used to be able to go to the CME in Chicago and do predictive trading on weather conditions.
Really?
Yeah, like a binary option.
Yeah.
Is it going to rain? Or what sort of storm? You used to predict that and get a binary option win or lose on
so
weather.
Like an intrinsic value upon the option. Yeah, that's interesting.
You could sell that, you see, because there won't be any oil. Oil will tank.
Yeah.
So you've got other ways of generating revenue, and you could probably predict that instead.
Yeah, that's interesting. Very interesting. There you go.
Whether you're prepared to, whether any bee booker is prepared to take the risk of a country where it's mostly sunny or not, I have no idea.
Well, we always need new markets ourselves, so maybe that'd be the next exclusive.
Exactly, it's a way of diversifying. That's right. Very interesting indeed. Nice to see you, Paul.
It's a pleasure, Andrew. Great as ever.
I'm Andrew Sachs-McLeod, CEO of FinanceFeeds. This is Paul Orford from TopFX. Thank you for joining us. See you soon. Goodbye.